morning, I am FAUZI and welcome to Ag News, bringing you accounting news from all over the world. Today's highlight is on agency theory, a branch of financial economics. Eager to know the details? Make sure to stay with us till the end. Agency theory fundamentally explains the conflicts of interest between people with different interests in the same asset. In this context, it means between shareholder and manager of the company. The theory further explains the principles, shareholder for instance, and agent such as company's manager being related as the principal delegates an agent to perform work. It attempts to deal with two specific problems, aligning the goals and reconcile different tolerance between the two. So where did this theory came from? It brings us back to 1960s and 1970s where the economists explored risk sharing and described that it arises when cooperating parties have different attitudes toward risk. Agency theory broadened this risk-sharing literature to include the so-called agency problem that occurs when cooperating parties have different goals and division of labor. To know more about agency theory, we have FADZLIN reports from Shah Alam, Selangor.
Can you hear me, Fasya?
Yes, we can hear you.
Okay, I am FADZLIN reporting from Bamba Berhad Building, Shah Alam. The station is under control here and fortunately Selangor has got their water supply running again. Also remember to wear mask and practice social distancing. We must fight this COVID-19 until the end. Okay, we go back to our business. There is a serious conflict of interest between shareholder and manager of Bamba Berhad. I saw just now there is a flying check coming outside this building.
That sounds serious, FADZLIN. Tell us more details.
There are conflicts between shareholder and management that may relate to what proportion of company's profit should be paid in future investment and for capital investment purposes. Other potential conflicts that may involve the company ethical policy, its corporate and social responsibility. In agency theory, this conflict is caused by the factor as reward management, risk attitude of management and shareholder, takeover decision by manager and time horizon of manager.
It seems like the managers have self-interested behavior for their own benefits. In imperfect labor and capital markets of company business, managers will seek to maximize their own utility at the expense of corporate shareholders.
That's right, Fasya. Manager as agent actually have the ability to act in their own self-interest rather than to act in their best interest of the firm because of asymmetry information. Of course, manager will know better than the shareholders whether the firm is capable of meeting shareholder objective or not, because managers are directly involved with daily company management.
Right, FADZLIN. Do you have any specification as to how we can identify clearly if the managers have self-interested behavior?
This can be when there is consumption of some corporate resource in the form of prerequisite and the avoidance of optimal disposition, whereby risk-averse managers bypass profitable opportunity in which the shareholder will prefer to invest. Then, also investor will realize the firm will make decisions contrary to their interests.
From what you say, what I can conclude here, the problem arises when the shareholders have no reason to believe that managers will always act in shareholders' best interests.
That's true. As far as I've known, in order to align the manager and shareholder interests, there will be agency costs borne by them. So later, we go into details about this agency cost with the representative from shareholder and manager team of Bambam Company inside this building. Let's go.
Alright, FADZLIN.
Here, I am FADZLIN again, live from Bambam Berhad's office. For this live interview, we got Ms. Hanis Zahira as CEO and Dato' IMAAN AISYA as the company's largest shareholder. I heard that there is a conflict between management and shareholder here. Ms. Hanis, as manager to the company's shareholder, can you share to us what's the main types of agency costs?
Thank you, FADZLIN. Okay, there are three types of agency costs, which are monitoring costs, bonding costs, and residual loss. For the first one, which is the monitoring cost, it is the cost of monitoring the agent's behavior to comply with laws and regulation and as far as possible align with the principal interest. The principal will incur the cost to check the agents are doing what they are supposed to do. For example, an external audit of the company financial statement is an example of monitoring costs. The directors of the company are responsible for preparing the financial statement, and this is ultimately borne by the principals.
Okay, what are the next two types of agency costs?
The second one is bonding costs. Bonding cost is the cost that arise when an agent attempts to prove that their interests and goals are aligned to the interests of principals and forming a relationship to build trust. So, bonding costs are borne by the agent. For example, a manager may agree to stay with the company even if the company is acquired. Therefore, the manager must forego other potential employment opportunities. So, consider that implicit cost or opportunity cost is an agency bonding cost. The third one is residual loss. Residual loss is the difference between perfect goal congruence and what is actually being achieved. In other words, residual loss are the costs incurred from difference between what the principal wants and what the agent actually does despite the use of monitoring and bonding. The residual loss is borne by the principal.
Dato, in your opinion, what is the best solution to have a win-win situation between you and company management as your agent?
In my opinion, the best mechanism to solve this situation is using settling up. What I mean by settling up is that the shareholder should evaluate the remuneration package given to the manager based on their effort. Therefore, the remuneration level must be tally with the manager's effort. If the manager acts more in our favor of interest, we will likely increase their remuneration. However, a manager remuneration is to be expected to decrease if he acts in contrary to our favor of interest. Thus, shareholders should determine remuneration level based on settling up.
The management should receive remuneration based on their efforts. I get that. So, Miss Hanis, is agency costs will totally disappear?
No, there is a residual opportunism. It means that after all actions taken to reduce agency costs, there are still chances for agents to have self-interest. For example, manager wants something for themselves, so they make decisions that at the end can give them benefit. For example, the management needs to go for an outstation and usually the company will pay for the expenses. This is an example of agency costs. In order to avoid manager from booking expensive hotel, the company will impose a policy to limit their expenses. However, manager will try to book the maximum price. If two people are going, they will book a room for each but stay together so that they can get benefits when claiming. With incomplete price protection and settling up, residual loss is borne partly by agent and partly by principal.
I see. Thank you, Miss Hanis. Dato, what are the actually relationship between agency problem and agency costs?
Agency problems and agency costs will not arise if there is no opportunistic behavior of management. First thing first, what is opportunistic behavior? Opportunistic behavior is an act or behavior of one person to maximize his self-interest and occasion loss of the other party. In this situation, the manager acts in his self-interest and shareholder will bond the loss. If manager keep having opportunistic behavior, shareholders' ownership will decrease as the manager is the one who handles the business and this will result in an increase of residual loss. However, we as shareholders, we bear the agency cost as long as marginal benefits for shareholders exceed marginal costs. Due to this, shareholders have price protection. It could be divided into two forms. The first one is share price adjustment to reflect opportunistic behavior. This means that the managers will change the share price so that it will look good by adjusting the figures in financial statement. When the share price is higher, the earning per share will increase. We will protect the shareholders as we will get a higher dividend. The second one is share price excluding monitoring and bonding costs. Both costs are borne by the managers. Unfortunately, price protection has its limitation. This is because share price is not always available due to thin trading. Shares cannot be easily sold or exchanged for cash without a significant change in price. Price protection also cannot protect shareholders when a manager's effort can be directly related to earnings performance.
I got this. You are worried about shareholder wealth and management as agent should maximize shareholder wealth accordingly. So, Miss Hanis and Dato, What are the actual mechanism for dealing with shareholder and manager conflicts?
That's a good question. There are two polar positions for dealing with shareholder-manager agency conflict, which are in the view as manager and shareholder. The firm's manager are compensated entirely on the basis of stock price changes. In this case, the agency cost will be low because managers will have great incentive to maximize shareholder wealth. It will be extremely difficult, however, to hire talented managers under these contractual terms because the firm's earnings will be affected by economic events that are not under managerial control. In the view of shareholder, I believe Datuk can explain more about it.
When the situation get worse, I think the best way is we would like to monitor every manager action if the managers persist in acting for his self-interest. However, this would be extremely costly and inefficient.
Okay, I got this. That's the optimal solution lies between your view, where executive compensation is tied to performance and some monetary is also undertaken. And for Datuk's point of view, there is a mechanism encouraged for manager to act in shareholder interest. Firstly, performance-based incentive plans. Second, have a direct intervention by shareholder. Third, threat of fire. And lastly, threat of takeover the company. I hope after this, the manager act as agent can make decision to keep principal best interest and avoid self-interest so that the shareholder can put more trust in the company and pump out more capital in the company. Thank you, Ms. Hanis and Dato Iman Aisha for accepting this interview. That's all from me. Back to the Fasya at the studio. Thank you.
Thank you, Fadzlin, and we are back here in the studio. It seems that Fadzil has come up with the best solution for dealing with the conflicts. Now, in the question of conflicts, does it occur between the shareholder and managers only, or perhaps there are other parties involved? We have invited Dr. AQILA, a Malaysian accounting professor in Sorbonne University, for a live video call from the city of Paris to comment on the topic. Hello, Dr. Ainin. How are you?
Bonjour, I'm good and ready to roll with you.
That's great. How are the cases of COVID-19 there in Paris?
Things are not getting any better. I have been staying at home for the past few weeks and getting my job done online. Tough time, but Alhamdulillah, me and my family are going through this together and we have been all being healthy.
It's good to hear that. Dr. Aini, we have all been discussing the conflicts between shareholder and manager in today's topic of agency theory. But the question now is, are there any other parties that are involved in this conflict as well? Mind if you can share your view on this?
Of course I can. Other than stock shareholders and manager, there is a second class of agency conflict which is between creditors and stockholders. Creditors have been the primary claim on part of the firm's earning in the form of interest and principal payments on the debt as well as a claim on the firm's assets in the event of bankruptcy. The stockholders, however, maintain control of the operating decisions that affect the firm's cash flow and their corresponding risk. This conflict can result in situations in which a firm's total value declines but its stock price rises. It occurs if the value of the firm's outstanding debt falls by more than increase in the value of the firm's common stock.
Turns out there aren't just shareholder and managers, but also stockholders and creditors involved with the agency conflict. How about the relationship between agency and contract? Are there any difference or similarities between the two?
Agency theory is a principle that is used to explain and resolve issues in the relationship between the business principals and their agents. Most commonly, that relationship is the one between shareholders as principal and the company executive as agents. The principals have hired the agents to perform a service on their behalf, while the contract theory is the study of how people and the organizations construct and develop legal agreement. It analyzes how parties with conflicting interests build formal and informal contract. Therefore, agency and contract basically the same.
So the two things are actually the same. The last question for the day, Doctor. How are agency and ethics connected?
As we all know that the agency is a contractual relationship between the two parties which are agents and principals. Ethics is a concept of right and wrong behavior defining for us when our actions are moral and when immoral. The principals have hired the agent to perform a moral service on their behalf. So, the agency should perform it legally and ethically to provide the best care possible to every principal. Agents are duty bound at law to act as fiduciary for their principals. Nowadays, there are many agents who leak out certain confidential data of their principal to other parties. This is one of unethical issue raised from unethical agents. Thus, agents should always act in principal interest.
Yes, doctor. As a human being, in any occasion, it's always back to ethics, even more so in business. Isn't that right, doctor?
Yes, absolutely.
All right, doctor. Thank you for your time here in Ag News, and we hope everything goes well for you at your place.
Yes, it goes to you.
And that's it for Ag News. May the news we've shared help you in any way. I'm FASYA FAUZI. Thank you for tuning in and stay safe.